I think it's the 4-year cycle still. I think the biggest risk is people will disagree with my view that this crypto winter started in January. And they'll say quite reasonably, I argue that it may have started in January. They'll say quite reasonably that no, it started in October, Matt. And the average winter is 13 months. So talk to me at Thanksgiving. I'll buy then. I think that's probably the biggest risk to the market. If we have a more modest series of developments, if the S&P 500 is middling along, if Warsh doesn't do anything when he takes over, if the Clarity Act fails, then I think that $100,000 will be a pretty hefty head for crypto this year.
Bitcoin's correlation to risk assets in general are at an all-time high. Because I think what happened with the Warsh announcement wasn't necessarily a Bitcoin sell-off, but it was actually a risk sell-off. And that correlation has increased pretty dramatically, I would say, since last summer, and got accentuated even with the news flow today. So I'm just personally very excited to see what's going to come through with it. And I think it is long-term very, very positive for Bitcoin.
Bitcoin is not doing what most people expected it to do right now, and the market's silence is growing louder than any crash. After all the institutional momentum, ETF inflows, corporate adoption, and regulatory tailwinds, Bitcoin is grinding lower rather than pushing toward new highs. Something is off. And the worst part is that the people who study this market closest cannot fully agree on why. The Fear and Greed Index recently reached 5 out of 100. Think about that for a second. The entire crypto market, with billions of dollars of capital, is sitting at near zero sentiment. That kind of reading does not just happen by accident. It means people are scared, exhausted, or done caring. And historically, that level of apathy is either the beginning of something very dark or the quietest buying opportunity most people will miss entirely. What makes this moment especially complicated is that it is not just one thing dragging the market down. You have old Bitcoin holders quietly offloading massive positions. You fear that quantum computing threatens the network's foundations. You have a new Fed chair coming in whose policies nobody can yet fully predict. And in the midst of all of that, you have the ghost of the 4-year cycle whispering that this winter is not over yet. Now, Matt Hougan believes the 4-year cycle is still the single biggest threat to Bitcoin right now, and that the market could keep bleeding simply because enough people have convinced themselves the crypto winter started in October, which by that math puts the bottom somewhere around Thanksgiving. Let's hear directly from Matt Hougan for more insights. Please don't forget to like, subscribe, and enable notifications. Thanks for tuning in. Enjoy the rest of the video.
I think it's the 4-year cycle still. I think the biggest risk is people will disagree with my view that this crypto winter started in January. And they'll say quite reasonably, I argue that it may have started in January. They'll say quite reasonably that no, it started in October, Matt. And the average winter is 13 months. So talk to me at Thanksgiving. I'll buy then. I think that's probably the biggest risk to the market. I know that's unsatisfyingly reflexive, right? Like the market will go down because people think the market will go down is like a 6-year-old analysis of crypto. I just happen to think that it's probably true in this case. The other risk that I actually think many of those other risks will turn around. So I think quantum will turn from a headwind to a tailwind. I do think the Bitcoin community is now listening on the quantum risk. I think developers are doing calls on the quantum risk. I wouldn't be surprised to see some sort of roadmap or chatter emerge in the next few months that becomes a positive. I think on the Kevin Warsh side, I think he's probably going to surprise to the upside on the rate cutting expectation. And I think the Treasury will do all the money printing it needs to do effectively, and he'll be somewhat constrained there. So I actually think maybe the negative Warsh impact is at a bottom and is going to turn around. I think the biggest risk is still just people assume the winter will last 13 months, start in October, call me in November and we'll bottom there. It's possible that happens. Yeah. I think people like me over-intellectualized the market at the start of 2025 and said it's going to be institutionally driven. And the factors that drove the 4-year cycle in the past are no longer as true as they are today. And that turned out to be incorrect. The institutional part was correct. Massive inflows, $75 billion of inflows into ETFs and corporations and Bitcoin alone last year. It's just, as you mentioned, $100 billion of selling by OGs. And that's a bigger number. So yeah, sometimes it's as simple as it is until it's not. Again, I'm not sure that it's right because I think the winter may be a little long in the tooth. We do have the lowest fear and greed measure in history. We got down to 5, which is, if you think about that, it can go to 0 or it can go to 100. That's a pretty asymmetric skew. So maybe we're closer to the end than the beginning. That's my optimistic take. From an investor perspective, maybe it's a good time to dollar cost average in. I wouldn't be trying to pick a precise bottom and assume we're going to V back up. My basic view, having spoken to some, but obviously not all of the OG crypto investing community, is they're not excited about selling at these levels. The flip side is, I hate to be the bearer of bad news, they're probably excited to sell again at 100,000. So there may be some overhead when we get back into that range. But look, I don't think we're going to see the kind of heavy selling that we saw earlier. I don't think people are giving up on crypto. I think it is going to bottom. It tends to bottom in exhaustion, to use your word, and apathy. It doesn't sort of bottom in excitement. So maybe once people stop paying attention to crypto is when it's going to be a great time to buy. Look, I'm looking in my Bitwise office. We have a team of like 50 people here. And you and I are talking about, well, it's a 4-year cycle and they sell at 100K. But it is a behaviorally driven asset. And I think that is just objectively true. We are humans. I think, I don't necessarily mean that we'll bounce our head off of it and come back down. I think that will be context dependent. So in other words, if we have a rip-roaring equity risk-on market, if the Clarity Act passes, if Warsh actually cuts rates more aggressively than people expect, if Japan stimulates the way people expect, if China's M2 continues to grow at the rate it's been growing, I think that's enough catalyst that we could push back and actually go to new all-time highs. If we have a more modest series of developments, if the S&P 500 is middling along, if Warsh doesn't do anything when he takes over, if the Clarity Act fails, then I think that $100,000 will be a pretty hefty head for crypto this year. So it's really context dependent on where we go. My actual take is that the reason it's part of it is largely because of a chart crime. There's a chart circulating that plots Bitcoin versus the software market. The unfortunate piece about that chart is it uses 2 different y-axes. So Bitcoin is measured on a scale that goes up 600% and software on a scale that goes up 100%. If you plot them on the same y-axis, they actually look remarkably different. You could pull up Bitcoin versus IGV, which is a software ETF, and plot them since 2024, and you'll see that they look nothing alike. I think I'm seeing a few of them. Yeah. Yeah. Like you have to take into account that the chart, the y-axes are just on completely different scales. This one made 3 different axes, which is a chart.
Yeah, it's a lot of different stuff.
Third order. If you actually plot these like a normal human would on a percentage return, they look nothing alike. I think what happened is Bitcoin was trading similar to all tech stocks until October, because the market was in a general risk on moment. Bitcoin is a risk on asset. And then in October, 2 things happened. Bitcoin had 1010 and Claude destroyed the software industry. And those are separate events, and they both caused the market to go down, but they're not correlated at all. I can't tease out why the destruction of Salesforce should be negative for Bitcoin. It doesn't make any sense to me. I don't think it's in the data. I think it's chart crimes run amok that is putting this narrative into people's minds. And I think it does work that way in specific market regimes. The specific market regime that it works that way is a steady state market regime where monetary liquidity is growing or shrinking at a great rate, because Bitcoin is more sensitive to those monetary liquidity changes than other assets, and therefore it's a leading asset. Yeah, part of me worries for the broader ecosystem that Bitcoin has been quite so crushed. The question in my mind is it crushed because of this reflexive 4-year cycle that we talked about? Or is it crushed because at least US monetary liquidity hasn't been as forthcoming as people thought? If it's the latter, then that does portend poorly for the rest of the market. But it's a question we're debating here. It was actually, sounds like you're in our research channel today. We were chatting about that a lot. I think there's a risk that it happens, but there's also the potential that in this case, Bitcoin's pullback was not driven by monetary liquidity, but rather by idiosyncratic Bitcoin factors. But it is on my mind. It does make me at least a little worried about the broader equity market.
Hougan says what makes this especially dangerous is its reflexive nature. The market will go down simply because enough people believe it will. He acknowledges how unsatisfying that sounds, almost too simple, but he stands by it. $100 billion worth of selling from long-term Bitcoin holders came in last year, and that number swallowed even the record ETF inflows whole. $75 billion poured into ETFs and corporate treasuries, and it still was not enough to hold the price up. The old hands were selling faster than the new institutions were buying. Meanwhile, Jeff Park adds another layer to this. He points out that Bitcoin's correlation to risk assets is now at an all-time high. When the Kevin Warsh Fed chair announcement hit, what people called a Bitcoin sell-off was actually a broader risk sell-off. Portfolio managers who now hold Bitcoin in multi-asset funds treat it the same way they treat any high beta position. When uncertainty rises, they sell everything together. Bitcoin no longer moves in isolation, and that shift in ownership structure is changing how the market behaves in ways most retail investors are not accounting for. Now, let's listen to Jeff Park for more insights and analysis.
What Warsh has shown is Bitcoin's correlation to risk assets in general are at an all-time high. Because I think what happened with the Warsh announcement wasn't necessarily a Bitcoin sell-off, but it was actually a risk sell-off. And that correlation has increased pretty dramatically, I would say, since last summer and got accentuated even with the news flow today. So I think there's two versions of the story, right? Because on one hand, there is this hawkish version of balance sheet reduction as a journey that we have not ventured into beyond what this ample reserve system could look like. And there's a lot of uncertainty about this, which is why I think you can see risk assets generally being sold off. And Bitcoin just is now correlated to that dynamic because it's owned by the same portfolio managers in a multi-asset framework where they're underwriting that to be a risk asset. But the thing that I'm long-term really bullish about Warsh is if he actually is able to be what I call like a very pragmatic economist to like rewriting the engines of what Fed independence should look like. There's a version where like the whole monetary setup as we know it is finally going to evolve into something that is a little bit more anti-fragile. And in that world, there's a restoration of what true store of value could look like as a reserve asset. So long term, I do feel like it's a little bit painful always to kind of introduce volatility to change from an institution that we've gotten very comfortable with. But deep down, like we all know the current system's not on a good path and we have to start like ripping the Band-Aid a little bit. But long term, like his holy grail towards what he wants the Fed to be and what he thinks the role of like the interest rate should be, I think all of that points towards a pretty positive, healthy mood for Bitcoin in the future. And I think there's a thing that people forget. Kevin Warsh actually, from his first term as Fed governor, resigned. And he actually left. And the reason he left was because he disagreed with the committee at the time of engaging in a second round of QE. Because he knew the first time when it happened in '08 what it took. But what he was against was this idea of complacency that now the QE framework is the backbone of the entire global financial framework where moral hazard is changing the cost of capital. And he was vehemently opposed to it to the point where actually he resigned, right? So like, I think this is incredible. Like we have an elite like academic who's also a huge capital markets practitioner, right? From Duquesne and Druckenmiller's days. And actually has the guts to just call the shots as he sees it. And that kind of iconoclastic regulator type personality is so far, as we all now see in the world, that if anyone can ever actually go on the venture of a new Treasury Fed Accord to reset people's expectations on the role of the dollar, I think this is it. I think this is the very powerful combination of personalities and expertise and culture that I don't know if we'll ever get a chance to replicate. So I'm just personally very excited to see what's going to come through with it. And I think it is long-term very, very positive for Bitcoin. The credit market in the end is an incredibly abundant and large market that most, even though retail investors don't participate in, is kind of the core of our financial system. And so in this world where like people are starved for yield and they're actually trying to think about where to earn appropriate yield that measures up to growth expectations, like we think we're in a period of decent yield because like the Fed's rate that's at 3.5 or whatever. But like actually what we've seen is on a real like rate, that's actually been pretty deflationary too, right? I think there's data that now show like most people who started their entry-level jobs post-college were now on the 6th year of their real wage having gone down. So there's actually like a real problem with like yield as a concept, even away from like nominal numbers. And the thing about Bitcoin is that like if you believe in the price appreciation that is possible over a long time frame, you can think about risk segmentation where people would choose to take something current today versus the volatility of underwriting the uncertainty of tomorrow. And so to me, I think it's a big market, and it's also a market that is heavily dictated by regulators in kind of like a box checking format, right? Like what I mean to say is like credit ratings matter, and to get credit ratings, you got to be able to do things that hasn't been done before, and so like there's things that just have to get solved. But yesterday I saw Ledin actually issued an ABS securitization for the first time that the S&P actually graded. And it was like a $200 million program where the junior piece was rated B minus, right? The equity tranche of an ABS securitization was rated B minus. That's the same credit rating as MicroStrategy, which actually would have a senior credit relative to all the other equity things they have in the past. All to say, I don't think the S&P knows what they're doing. Like, I actually don't think people have an understanding of like what the appropriate credit rating should be on these things. And that's basically an opportunity for somebody who is smart and clever to think about what that appropriate risk-adjusted return is. And people are going to figure it out. And so I think it's a question of like just risk tranching and risk preferences. And because we all know in the end, institutions, right, they're motivated by different things than principal investors like you and I that are here. They actually have, you know, a lot more guardrails as to how they're measured on their performance success, the volatility drawdowns, and the current operating needs that they have to support. And credit just fits a role that Bitcoin historically, because it is a non-cash flowing asset, could never tap into. And this digital credit finally opens a path, an aperture for that class of investors to come in, which I think is huge. I think the next, versions of Bitcoin treasury companies we'll continue to see will probably fall into that kind of more kind of advanced operation of trying to make the Bitcoin useful somehow, or finding cash flows adjacent to Bitcoin that can also bring more utility to the underlying balance sheet.
Jeff Park takes this further when talking about Kevin Warsh specifically. He believes Warsh may be the most consequential Fed chair appointment in a generation, not because he will be easy on markets, but because he has the intellectual conviction and the personal track record to actually challenge how the Fed operates. Park points out that Warsh resigned during his first term precisely because he refused to accept that endless quantitative easing was a healthy policy. He was vehemently opposed to the moral hazard that QE was creating across global financial markets, and he walked away rather than go along with it. That kind of independence is almost unheard of in that role. Park sees Warsh as someone who combines elite academic thinking with real capital markets experience, and believes that if anyone can reset people's expectations around the role of the dollar and what a true store of value should look like, it is this combination of personalities now in place. Long-term, Park says, that is very positive for Bitcoin. On the other hand, Hougan does not think the selling pressure from original Bitcoin holders will remain at these levels forever. He has spoken to enough of that community to believe they are not excited about unloading at current prices. But here is the uncomfortable part. He also admits they will almost certainly want to sell again when Bitcoin returns to $100,000. That round number is not a coincidence. It is a behavioral checkpoint baked into how this market has always worked, and it creates a ceiling that could slow any recovery just as momentum starts to build again. However, Hougan sees real optimism if the right conditions line up. Where the Clarity Act passes, where Warsh cuts rates more aggressively than expected, where Japan stimulates, and China's money supply keeps expanding. In that world, 100,000 is not a ceiling, it is just a speed bump on the way to new all-time highs. Park sees the macro architecture shifting in a way that makes Bitcoin's long-term role unavoidable. The institutions are here. The regulatory conversation has shifted, and the people now sitting at the top of monetary policy actually understand what broken systems look like. The question is not whether Bitcoin survives this period. The question is whether you will still be holding it when it does. So are we closer to the end of this Bitcoin winter than the beginning, or is the worst still ahead? Thanks for watching, and don't forget to like and subscribe.